Good morning, everybody, and welcome to part 2 of our succession series. Today's webinar is all about doing the deal. We welcome questions, so if you please can you add them to the Q&A box and we will answer these at the end. Thanks, everyone. Over to you, Paul.
Morning, everybody, and thanks very much for joining us this morning to talk about the second in our series of succession planning webinars. This time on actually doing the deal, and I'm really pleased to be joined by a good friend and colleague of mine, Ryan Niblock from Cleveland Scott. I'll let Ryan introduce himself in a moment, but Ryan will bring some real great insights, I think, into the practicalities and the realities of actually doing a deal. So, without further ado, let's just move on. And hopefully most of you who are on the webinar know who ETC Tax are, but we're a firm of tax specialists based in Altrincham in South Manchester. And we really only provide tax advice. We don't do any compliance work. We're just specialists in tax advisory work, and we cover most of the taxes that your clients and you as a business owner would potentially encounter as you go through the business life cycle. And we work both with individuals and businesses, and work a lot with other professional advisors, the likes of the guys at Cleveland Scott, to sort of support their clients on relevant issues from a tax point of view. So, without further ado, I'll allow Ryan to introduce himself.
Hi, everyone, and thanks for that intro, Paul. As Paul mentioned, I'm Ryan Niblock. I'm a corporate finance director at Cleveland Scott. I'm a chartered accountant by background. I trained in audit before moving into corporate finance about 8 years ago. Cleveland Scott, we are a sell-side focused M&A boutique, and we're based in Stockton Heath, just outside Warrington. There's 4 of us in the team, and between us, we've probably got about 60 years experience, and we've completed over 125 transactions. So yeah, we've seen some weird and wonderful things between all those different deals. So we primarily advise owner managers in a whole variety of different sectors, and most of our deals are between £5 to £20 million value. Just give a bit of a flavour in terms of the deals we do. So recently we've advised a solar panel and heat pump installer, an electronics manufacturer, a commercial cleaner providing services into the healthcare industry, and a translation services provider. Okay.
Yeah, all good.
Yeah.
Press on.
Yeah. So, this slide, very sort of high level, indicates the timescales that's involved in a transaction from the preparation phase all the way to the completion phase. So typically we see, from we get involved, a sales process will last between about 8 to 9 months. Normally about 6 weeks for the preparation phase, 6 to 8 weeks of marketing. This is very, very dependent on the time of year you go to market. School holidays tend to play quite a big factor in that, unfortunately. 2 weeks of actually negotiating the deal, 6 weeks of due diligence, and then 6 weeks of legals before completion. So yeah, so it sounds very easy, doesn't it? So, so the planning stage is probably one of the most crucial for us, and it's where, as advisors, we feel that we can really add the most value. And we can do this just really through kind of our knowledge of what a deal's like, and really in terms of what buyers are after. I mean, probably, Paul, for you as well, this is a really important bit.
Yeah, it absolutely is. I think there's a lot of work that can be done from a tax point of view to maximise the value, but also make sure that when the time comes, we've got the structure right. So as the tax outcomes that we achieve for the sellers are in line with their expectations, because there's nothing worse than achieving a great price at a top line and then finding that a much bigger chunk than you were expecting is going to disappear in tax. So yeah, that preparation from our point of view, whether it's restructuring, extracting assets, whether it's tying people in through share schemes, is absolutely the kind of area where we can add a lot of value, I think.
Good. So we spend an awful lot of time really sort of understanding businesses, and we do this initially by sending out a bit of a small information request. And this is sort of things like financial information, what our client's view of the market is, a little bit about the management team. And this really gives us the ability to do 3 things. So 1, it allows us to advise our client on the best type of transaction they should do. Should they look for a trade sale? Should they look at a private equity sale? When you should start a process, and that's really important. Some businesses, they're ready to start it straight away. Others, really, the best advice is you should be thinking about doing this in 12 months. because there's things you can do which is going to improve their value and actually just make the whole process easier. And ultimately, what's most important for most of our clients anyway is what our view and valuation is. I thought it would probably just be worth taking a couple of minutes just to run through kind of how we come up with the value for a business. So most businesses are valued on a multiple of recurring profits, on a cash-free, debt-free basis, and I'll come to the cash-free, debt-free bit shortly. Most buyers will view recurring profits as EBITDA, which is your earnings before interest, taxation, depreciation, and amortization. EBITDA times your multiple gives you an enterprise value. In our view at the minute, most businesses are probably getting between about 4 to 7 times in terms of the multiple. So what we do at this stage, and we spend quite a bit of time doing this, is reviewing the client's P&L, and we do this really to try and identify any one-off costs or non-recurring costs that a potential buyer is not going to incur going forward. And really in this, we really have seen all sorts. So season tickets, which is pretty normal, but we've also seen family ski trips, and believe it or not, we've actually seen racehorses going through a P&L as well. But really what this allows us to do is to present a higher possible EBITDA to a potential buyer. And obviously that sort of increment, the multiple gets applied to that. So it is a bit time consuming and there's lots of questions involved, but ultimately it is really a worthwhile exercise. So once we've established the enterprise value, another adjustment's made, and that's sort of the cash-free, debt-free, which I was discussing, and that's the deal will increase pound for pound for every bit of cash and decrease for every bit of debt. Cash is quite simple; it's just cash, it's what's in your bank. But debt can be a whole variety of things, so include loans, invoice discounting, deposits, corporation tax, and hire purchase agreements. So we make one final adjustment before we arrive at an overall value for the business. We call this the working capital adjustment. And essentially what this is, we look at the net of your debtors, your stock, your PAYE, your NIC, your VAT, at the point of completion. And then we compare that to what the average is. And really, it just helps us establish that if there's a big peak in debtors and cash has gone down, it's beneficial for our client. And that's really why this is quite an important adjustment. And this adjustment then gets added to the enterprise value. Any increase or any surplus, is added to the value, and any deficit is deducted. So the cash-free, debt-free, and working capital adjustments, collectively known as the free cash adjustment, and essentially it establishes how much cash you can actually take out at completion. A lot of our clients look at their bank balance and think, oh, we can extract all this at completion. And unfortunately, we have to break the bad news to them that that's not quite the case. But it's obviously, it's an important thing to do, and it can really increase the value if we can get the cash point right. So we thought it'd just to kind of bring this to life a little bit, give an indication of how this works. So if we've got a business making £1 million profit, so it's good business, £1 million of EBITDA, we'll look through the P&L. Say the business has 2 shareholders and they're both sort of paying themselves 200 grand each through through salaries and pensions, etc. Feels a bit excessive, really, for a business of that size to be paying that much. So we'll add back that 400 grand, and we'll say, tell you what, about 100 grand seems reasonable for shareholders running the business. So we deduct 200 grand as a market rate salary. During the year, the business has recruited a CFO and a sales director. So they're one-off costs which shouldn't occur going forward. They're already in place. We add back that 50 grand and say we've got 4 season tickets, for Old Trafford. Again, a buyer's probably not going to want them going forward. So we'd add that back as well. So originally the business had an EBITDA of £1 million, but we're telling a buyer actually, that's that EBITDA is 1.27, not the 1. And the business is operating in a really good space, got really good growth prospects, really good management team. So we think it's going to attract good multiples, say 6 times. And I think this really kind of shows the importance of doing this sort of exercise to run through the P&L, because we've gone from an enterprise value which would have been 6 million and is now 7.6. So it sort of shows the importance of doing this. And the business has a very healthy cash position of £1 million. So we get an overall value of just over 8.6. So next bit on planning stages. So we've established with our client when the right time to go to market is and the likely value which we think we're going to get for the business. We then send another detailed list, client sort of information, and this list really allows us to begin to write the information memorandum, really getting into the details of it. But what it also does, and we'll come on to this sort of later, is really start to get our client ready for the due diligence process, which is it's important to start planning for that as soon as possible. We also discuss with what the best type of transaction is with the shareholders at that stage, and is that a trade sale, is it a private equity sale, or do we try and sell it to the management team? What we do sort of more often than not is we can run these processes concurrently, and that depends on a variety of sectors, but particularly it's around the strength of the management team. So while we're drafting the IM, we also begin to prepare a list of potential buyers, and we've got a number of different ways of doing this. We do our own research. We've got some bits of software where we can kind of look at deals going on in the space. Quite often we get recommendations for buyers from intermediaries. So we regularly have meetings with the likes of Paul, lawyers, bankers, etc., who may have done deals in this space before, or just know people in that as well. But ultimately, one of the sort of good sources of knowledge for us is our source of buyers for us is our own clients' knowledge. I mean, they know the business better than anyone else, and in many instances they may have been approached in the past as well. So we add those people to the list as well. Once that's all done, we prepare a one-page anonymous summary called a teaser or a flyer, and that's what we send out to clients, potential buyers, sorry. So we've now got everything ready, and we are ready to go out and approach potential buyers. And this phase we call the marketing phase, and it typically lasts sort of between 6 to 8 weeks. Again, as I said before, it really depends on the time of the year. So initially, we try to make contact with people over the phone. If it's people we spoke to before, it's quite easy. We've got their numbers. We can ring the office, and we also get quite a few warm introductions from intermediaries. So once we've spoken to people and we've established sort of the interest they have in the opportunity, we'll then send a teaser to them. And if they're still interested at that stage, we'll then send an IM, an NDA. They'll sign the NDA, and then we'll issue the IM. When we send out the IM, we also send out what's called a process letter. The process letter details a lot of stuff, but most importantly, it details when offers need to be received by. And it tells the potential buyer what further information we need when we're going to go through their offer. So we need things like the structure of the offer. Is it how much the fair consideration earn out? Is everything on day one? How they're going to fund the deal? Is it going to be through their own resources, or are they going to have to get bank funding? And details of their due diligence process and legal process, and what lawyers they intend to use. One of the things which we really, really encourage during the marketing phase, and to do this before any offers are submitted, is for our client to have a meeting with potential buyers. And there's sort of two reasons for this. Is one, it allows them to sort of meet the buyer and really bring the IM to life. It gives a lot more sort of context to it, and it allows the buyer to understand more about the business. But particularly for our client, they can understand what a buyer is going to be like in terms of their culture, what the future plans are for the business, the company, the staff. They really get a feeling of what a buyer is going to be like to work with if they are tied in for a period. And we have had examples in the past where we've had meetings, and a client's turned around us after the meeting with a potential buyer and said, I can't work with them for 2 or 3 years. So they are really worthwhile exercises. So as I mentioned on the previous slide, we set a deadline for all offers to be submitted by. And once all these offers come in, we'll sit down with our client, and we'll go through these offers in detail, and we'll highlight any positives and negatives of each offer, and really point out obviously the financial implications, but what the non-financial points are as well, which they need to consider, such as length of service and what a buyer's plan is for the business. Are they going to sort of just move everything off site and make everything redundant? Stuff like that is really important to understand. Once we've gone through the offers, we'll then respond to each one, each buyer in turn, and just really say to them, look, this is what we like, this is what we don't like, this is what you need to improve. And then we set a final deadline for buyers to submit their best and final offers. That's normally sort of two or 3 weeks away. And sort of that gives time for a second meeting as well if needs be. So hopefully we get to the stage when, we've had 4 or 5 really good offers, one standout one, and that's who we decide to go with. And at that stage, we draw up a document called the heads of terms, and this really details all the key terms. Essentially, it's an agreement in principle. It's not legally binding, but it'll set out the total price, the structure of the offer, including any cash, deferred, earn-out, any equity. The mechanism how we're going to extract the free cash is that a lockbox mechanism, it's a completion accounts. The length of the shareholder is going to have to stay in for, which is obviously very important. And what's also really important, and the one bit which is legally binding, is the period of exclusivity, where we agree we're not going to speak to anyone else. That's typically 3 months, but that allows a buyer to carry out the due diligence and hopefully get the legal process done. In some instances, you'll get sort of legal points negotiated during the heads of terms as well. So warranties, de minimis levels, earn-out protections, etc. It very much depends on the buyer. Sometimes we do it, sometimes we don't. I think, is there anything in the heads of terms, Paul, you particularly like to get involved with? Or
no, I mean, I think from our point of view, it's almost a little bit pre-heads in terms of helping assess the offers, really. As I'll touch on in a short while. Yeah, the structure of the deal can really significantly affect how much tax the seller pays and when. So it's kind of helping them before you get to heads and when you're considering the offers to sort of understand, what the net after tax position is going to be and the timing of the tax as well, to help them to sort of properly understand, the bottom line of an offer as well as the top line, I think. So
yeah. So once the heads of terms are signed, we begin what is, without doubt, my favorite part of any transaction, which is the due diligence process. And I'm sure anyone who's been through it will attest to that. It's probably the most challenging and stressful period of a transaction. As a buyer, it's got to crawl over every element of the business. And it's a bit where we kind of really try and make ourselves the point of contact for the buyer. Essentially, it allows us to field any questions, to answer what we can do, to sort of back any questions which we think are a bit, don't really need to be answered at this stage. And it allows our client to just focus on running the business, because they can really quickly get distracted by the huge volume of questions which are going to come in. I touched on this right at the very start, but we spend an awful lot of time really trying to get our clients ready for the DD process. And this allows us to get ahead of any issues which may come up. And again, we have seen some very interesting things which come out. But really, the sooner we find out about issues like this, the more we can kind of manage it. And hopefully there's ultimately no impact on price. Again, Paul, this is probably something which we work very closely with you on in terms of the
in terms of the DD side of things, yeah, absolutely. And I'll touch on some of the sort of tax risks that come out of DD, but that's a particularly favourite area, I think, for buyers to pick up on issues, isn't it?
So there's three main strands of due diligence: financial, tax, and legal, and they'll typically appear in every deal. But private equity businesses, they tend to have a lot more, including commercial, where they're looking at customers; management, where they're reviewing your management team, just see how strong they are; ESG, DD, which is probably more prominent now, but it's just essentially showing you the business is doing kind of everything in the right way; technology, which is making sure you've got the proper systems in place; insurance, very self-explanatory, making sure you're insured properly; and then cyber, which is just making sure you're secure online and there's no kind of vulnerabilities at that stage. Private equity will also, during the financial DD, review the financial model, which is something which we tend to help our clients prepare. But again, that's quite a big element which needs to be considered. The financial due diligence it's where we really negotiate the free cash element, which we discussed before. And this allows us to tell our client how much cash they'll be able to take out on day one. And it's an area where we spend an awful lot of time negotiating, so we can really kind of get that cash in our clients' hands. I mean, a good example of of how much work kind of goes into this. So we've recently had a client who had about, I think, about £3.5 million in the bank, and the buyer's first kind of offer for that cash was about 700 grand, which you can imagine went down very well. But we ultimately negotiated a position where he was able to extract 2.7. So again, it's one of those things where there's a lot of negotiations. It's quite timely and stressful at times, but ultimately, it's a really worthwhile exercise. So once the DD process is well underway, a number of legal documents get circulated, normally by the buyer, and that formalizes the actual purchase of the business. And that's the main document on that is the share and purchase agreement, the SPA. And the SPA will set out the amount of consideration is paid, when it's paid, and if there's any targets which need to be hit, just to make sure you achieve that earn-out. Included in the SPA, there's a number of warranties which need to be disclosed against, and this happens in the form of a disclosure letter. And the warranties essentially are a set of statements about your business, and you need to confirm whether or not those statements are true. And by disclosing against these warranties, it sort of helps you there not be a warranty claim going forward. And again, tax is another big point on this as well, where there's a whole sort of raft of tax warranties which Paul gets really involved with.
Yeah, absolutely.
And the SPA will also set out a number of seller protections, which shows protects the client in terms of how the business will be run post deal, really, and it's particularly important for an earn-out. And it's things like, if a buyer wants to recruit a load of staff, which we don't feel is necessary, fair enough, they can do that, but that would then need to be added back, and wouldn't impact our client being able to get their earn-out. Some transactions, it's probably more private equity thing again, will also include a new shareholders agreement or a new set of articles. And essentially this will form how the company is going to be run post completion. So once all these documents are agreed, so we all get in a room, but we don't do that anymore. We all just go online now, and all the documents are signed, and that's it. The deal's completed, which is always the best bit.
Excellent. Thanks very much, Ryan. So yeah, please do pop any questions that you've got into the Q&A box, and Sarah will pick those up at the end. But I think that gives a real great insight into the deal process and how getting the right professional on board to support you can really maximize the value. I know I've seen instances where clients have kind of initially gone to their potential buyer on their own and suggested a value on a EBITDA basis, which has turned out to be significantly lower than what they actually could have achieved. But once you've got that number out there, I think it becomes increasingly difficult to sort of wind back from it. So it's getting that advice early and really understanding what you can do to maximize the value, I think, is where the likes of Ryan and his colleagues can really come in to sort of add a huge amount of value through the process. So move on to the really exciting stuff, which is the tax bit. So I think, from a tax point of view, I think the last session we talked about what you can do to get ready for the deal to sort of make sure the structure's right. And but I think one of the key areas, and we touched on it briefly just then when Ryan was talking, is from a tax point of view is really just what actually is the deal going to cost you in terms of tax. So I think I've said many times before, there's a big assumption from a lot of business owners, well, I'll just pay 10% tax and that's it. And I think actually, there is a real degree of complexity in here, and particularly in private equity deals, then the consideration structure, the deal structure can get really quite complicated. And the tax implications of that can change. And actually, if you get it wrong, can lead to some really nasty surprises. So, I think Ryan's touched on, some of the key things, but, from my point of view, it's really not just understanding what the top line number is, but what the actual bottom line number is, but also, sort of how at risk you are for subsequent payments if it's deferred over a long period of time. And as Ryan said, how long you're tied in. I know I've seen one example where somebody, spent 6 months in a business was supposed to be there for 3 years. Their earn-out was dependent on them staying for 3 years, and they just couldn't stand it any longer and walked away from about £1 million earn-out. So that kind of cultural fit that Ryan talked about is massively important as well. So let's talk about the various different elements and how they impact on your tax position as a seller or on your client's position if you're advising them. So simplest element, day one cash. Capital gains tax applies in most situations. I say most situations because there are some anti-avoidance rules that can kick in if HMRC think that you're artificially doing a deal to try and get some cash out and pay capital gains tax as opposed to taking it out as a dividend. So I think in most of the situations that Ryan's dealing with, that's never going to be an issue. But in some PE deals where it's perhaps only a relatively small stake that's getting taken, then that can become a real risk, actually. So it's something that's really important to understand. But assuming we do get capital gains tax treatment, then effectively you pay tax on your self-assessment for the year of disposal. And this is where timing of the transaction can be really interesting, because if you sell a deal, if you sell your business on 5th of April, you're paying your tax 12 months earlier than you would do if you sold the business on the 6th of April. I know that's an extreme example, but thinking about the timing in terms of that business cycle, but also the tax year is can be quite important. And for the most part, if you're selling a trading business, we'd expect BADR to be applicable. Although for those of you who are on the last session, will know that's not something that you can make any assumptions about. Deferred consideration is the next type of consideration, which I think we'll see quite often in terms of the deals that we're advising on. And what I mean by that is essentially it's a fixed amount, but you don't get it until later. It might be that you only get it after 12 months or you get it after 2 years. But it is a fixed amount. You know how much you're going to get. You just know that you're going to wait to receive it. But from a tax point of view, the law effectively treats you as if you'd received that cash on day one. So it's almost as if you'd had that money, rather than, even if you have to wait for it for 3 years, that you're still paying the tax on the same day as the cash that you've actually received as part of your day one consideration. So again, just factoring that in and understanding, what your cash flows are in respect of the tax is really, really important. There is a mechanism whereby you can ask HMRC to defer some of the tax on deferred consideration, but the conditions are so ridiculously tight that I think I've seen one person succeed in the last 10 years that I've been advising on this sort of stuff. So make the assumption that any deferred, you're going to be paying tax as if you'd received the cash on the first day. Sometimes, and I think, again, particularly in private equity deals, we might see what we call loan notes, which is effectively almost as if the sellers received the cash, but then straight away lent it back to the buyer, and then that gets paid over time. I won't bore you with the details, but you might, if you get into a transaction, Ryan's smiling because I know how much he loves this particular distinction. How that loan note is written can have a real impact on what the tax treatment is as well. So essentially the base case is for a loan note, you kind of don't pay the tax until you actually redeem the loan note. So that's one instance where you can defer the tax. But if you structure the loan note in the wrong way, then even if the loan note expires, it might be, say, a 10-year loan note for the sake of argument. Once it expires, if you've never received the cash, you can still end up getting taxed as if you had received the cash. So again, this is where the drafting and understanding how these things work is really important. Because getting the drafting wrong, if you get disappointed and the money doesn't come in, you could still end up paying the tax on it, even if you'd never actually received it. So again, it's really just around that drafting, and that's where I think we come in, and the lawyers, will understand the distinction, but it's also advising the clients as to what the best option is from their point of view. As with sort of, you do have a certain degree of choice around loan notes. You can actually elect to be taxed up front, and you might think, well, why on earth would I do that? Well, what you're doing is you're locking in the tax rate, and if you qualify for BADR, then if you've got some capacity on that left, BADR, I should say, is entrepreneurs relief by a different name for those who aren't familiar with the terminology. You can actually mean that you can actually secure that tax rate. So like at the moment, we've got an election today. Every possibility capital gains tax rates may go up in the not too distant future. By electing to be taxed up front, you lock in the rate at the day you do the deal. You're not exposed to the risk of rates going up in the future. Another element which less common but still does happen, and again, is a feature of private equity deals, I think, is where part of the consideration that the seller receives is actually shares in the acquiring company. And from a tax point of view, again, much like the loan notes, you can actually effectively defer the tax on that element until you sell the shares further down the line. So if you get 10% of your shares get rolled into shares in the new company, then on a base case and providing, you know, certain conditions are met, then effectively you don't pay tax on that value that you've received until you sell the shares into the future. Again, you can elect to be taxed up front on those. But I think I've said it's a one-way street there, and effectively what that means is that once you've elected in, you can't say, well, actually, no, I've changed my mind, and I'd like to defer the tax now. So if you decide to be taxed up front, then there is no going back at that stage. Now, you might think that sounded fairly complicated, but when we get to earnouts, then this is where it really does start to get quite complicated from a tax point of view, and where I think I'll touch on in a few minutes, where things can go, you know, really quite badly wrong. So an earnout, as I think Ryan said, you know, typically it'll be determined by the future profits of the business. So clearly at the day they do the deal, you've got no real idea, or clearly you've got no idea at all what those future profits are gonna be. So from a tax point of view, refer to earnout consideration as being unascertainable, because basically at the time we do the deal, we genuinely don't know how much you're going to get. So, but the tax man says, well, actually that may be the case, but we don't want to let you off having to pay tax on some of this value, at least on day one. So what we have to do is we have to kind of almost form a view as to how much we think that you will actually receive in the future. So we call this valuing the right to receive the money. So we might say, well, we think, you know, the maximum earnout's £1 million. We think there's an 80% chance that you might get all of that. And by the time we apply the time value of money, we might say, well, actually, we might think that the value that you're likely to receive is, let's call it 700,000 in that instance. And that's the amount that then gets brought into your capital gains tax calculation, and the amount that you pay tax on at the time that you actually, you know, are on the same basis as day one consideration. So you put 700,000 in then. If subsequently you receive 800,000 as a result of the earnout, because things go better than we anticipated at the time, then the extra 100,000 you receive there is taxed, but it's only taxed in the year that you actually receive it. The good news is that if you put 700k in and the wheels fall off and you only receive 500 as a result of the earnout, you can actually go back and get the tax back from the year of disposal. But obviously you've had that cash flow hit of paying the tax on that estimate and then not ultimately receiving it. So straight away you can see that actually there's a bit of complexity around earnouts, and I'm always thrilled when I see an earnout element in the consideration in a deal, because it just adds this layer of complexity. But I think the other thing to say, and I think I'll touch on this in a little bit more detail, is getting that drafting right for the terms of the earnout in the SPA that Ryan referred to is really, really critical, because HMRC are not averse to coming along and saying, well, actually, we don't think that's a capital gains tax item at all, because it's effectively tied to your services over the next 3 years that you're going to receive the earnout. So we think we're going to tax that as employment income rather than as a capital gain. And the effect of that, as you can imagine, you might be expecting to pay 10 or 20% on your capital gains tax disposal, but actually you end up paying anything up to 45% plus national insurance on it. So this is what I mean by really understanding how much tax you're actually going to pay, because Ryan negotiates your brilliant deal and then you end up paying 25% tax, more tax on it than you expected to. That's likely to be a disappointing outcome. And there's things like if the earnout's linked to future employment, or not all shareholders are getting the earnout, which is often the case, then they're the sort of things that might sort of get HMRC to start to think, well, actually, you know, is this really a capital gains tax thing at all? I think, you know, Ryan, again, touched on warranties and indemnities, and this is a big part of that share purchase agreement, is the tax warranties and indemnities. And basically what this is allowing the buyer to do is to keep the seller on the hook for, you know, things that go wrong, which may have kind of happened pre-sale, but which effectively don't come out of the woodwork until later down the line. And I won't go into the legalities because I'm not a lawyer, but essentially you as a seller is kind of making certain statements to say that this is true. And if it subsequently proves that it isn't true, and that results in an additional tax cost to the buyer, then the buyer is going to come back to the seller and said, well, we relied on this. It proved to be wrong. Therefore, we'd like you to put your hand in your pocket, please, and actually and actually pay us some cash for that. And quite often in deals these days, and I don't know whether Ryan sees this, but you will get retentions by the buyers.
Yeah, I think particularly private equity funds are quite keen on that. And again, I think it might just be a reflection of the market at the minute. There definitely seems to be a more risk-averse market from buyers, but retentions are certainly becoming a lot more common, particularly in private equity transactions.
Yeah, and I think that's certainly something that we see, because the buyer, it's much easier for the buyer to deduct it from money that they're holding on behalf of the seller than it is to go back to the seller and ask them for the money back when they might have disappeared off to live in Barbados, for example. So warranties and indemnities, and quite often, the sort of as the seller will typically, the buyer will typically draft the share purchase agreement, then their solicitors will typically throw everything, including the kitchen sink, at the warranties and try and hold the seller accountable for vast ranges of things. And sometimes, with no disrespect to my colleagues in the legal profession, but sometimes some of it is so clearly not applicable that we just kind of come along initially and say, well, that just doesn't apply. It's a purely UK business. You're asking them to warrant that they haven't got any tax exposures in Outer Mongolia, for example. We're not going to wear that. We'll take that out. Or actually, they're being unreasonable because they're asking the seller to be on the hook for things which are, something that they've got no knowledge of at the time and is totally outside of their control. So there's often quite a bit of toing and froing over the warranties and the indemnities to make sure that we're advising the seller that they're actually, what the buyer is asking them to sort of warrant or indemnify against is actually reasonable, and they're not just, keeping them on the hook for things that, really wouldn't be reasonable to expect them to stand behind. And the other really exciting bit is the SPA is the tax covenant. And essentially what this does is it, first of all, provides a mechanism whereby if there are extra costs that come out in terms of tax post the deal, this is the mechanism by which the buyer would kind of go back and make the claim to the seller. The seller, typically will be responsible for all tax liabilities up to completion, and the buyer after completion. But it's, I think that the wording's really important, because it's not so much what the seller should be paying, but what they're not required to pay. So if it's already been paid, self-evidently, you shouldn't have to pay for that. But also, if it's been recognised in the completion accounts, for example, it needs to be clear that that's reflected in Ryan's free cash calculation ultimately, and therefore the seller shouldn't be on the hook. Or if the government, however unlikely, comes along and retrospectively changes the law, then there's no way from a seller's point of view that they should be on the hook for something that happens, potentially post-sale. But the other critical part of this is actually who handles the tax affairs of the business going forward. So typically, it'll look at, well, who submits the tax computations, who handles enquiries. The buyer will almost always want control of those. And it's difficult often to push back on that, because they by that stage own the company. But it's really important to get the right for the seller to actually influence the process, because frankly, let's be brutally honest, if the buyer gets an inquiry from HMRC which impacts on a period they've got the seller on the hook for, they're not necessarily going to try awfully hard in the first instance to defend that, because if they just roll over and let HMRC tickle their tummy, then the buyer's going to say to the seller, we'd like you to pay this tax for us. So making sure that the seller is properly protected and has a right to influence this process is massively key in terms of reviewing that tax covenant. So that's the theory. Let's talk about the practice and where we see it going wrong. And Ryan's already touched on this. I won't bore you. And again, this was a big part of what we talked about in the previous session. Forward planning is essential. Don't make assumptions about things like substantial shareholder, entrepreneurs relief, BADR, because there's so many ways that you can trip up. Think about, if you're selling a subsidiary, does that qualify for the tax exemption that applies to selling trading businesses? But there's conditions you've got to meet. Don't, really make sure that if there's any tax, any assumptions around tax, make sure you're validating those and preparing for those. Get any assets out, because Ryan mentioned the season tickets, but it might be you've got a buy to let, or there's a commercial investment property. The buyer ain't going to be interested in that. So think about how you can actually extract that. Due diligence, again, just emphasizing what Ryan said, be ready. If there's any risks in there, make sure that you identify them, you manage them, you deal with them, because it's much easier for you to deal with them than it is to try and defend against the buyer challenging you when the time comes. Tax risks particularly are a great way for the buyer to try and chip the price. And as we mentioned, they may well hold back proceeds until the issue is resolved. And actually what we're seeing increasingly is the buyers coming along and saying, well, we've got a great, relationship with HMRC. We don't want to spoil this by them potentially finding a problem in the business that we've bought. So actually what we're going to do is we think this is an issue. So post-sale, we're just going to go to HMRC and make a disclosure about it and say, here's a chunk of tax, and we're going to knock that off the seller's proceeds. So again, being in control of that process and being prepared in the same way that Ryan talked about is massively, massively important, because it just gives you the ability to be on the front foot. In terms of ways that we can help to sort of achieve better outcomes from a tax point of view, a classic is directors' loan accounts. I'm sure you see this all the time, right? Where essentially the way it works, and again, it's a bit counterintuitive how it works in terms of the mechanism, but essentially when you do a deal, it's possible to structure it so as rather than having to vote a dividend or take a bonus to clear your director's loan account, the director's loan account can be cleared as part of the deal, and you only pay capital gains tax rates on clearing the DLA. So quite often you'll see sellers actually almost subconsciously building up their director's loan account prior to the sale, because they think, well, I'll just be able to pay it off all as part of the deal. And it's a well-trodden path, but again, structuring it right and making sure that that the lawyers kind of are aware that that's how it's going to work in the transaction. And I think that's one of the things in heads of terms that potentially you might put in there, is how we're going to deal with that. But those of you sort of familiar with the concept will know that if you have an overdrawn director's loan account, the company has to pay tax to HMRC. We refer to it as Section 455 tax. Now that's tax on the balance of the loan account, which isn't repaid. But when that loan account is repaid, then that money comes back to the company. So it's really important to make sure that in Ryan's calculations in terms of that free cash, that the repayment of that tax is factored in, so the seller gets the benefit of it rather than the buyer. Again, it might seem like a sort of semantics, but actually getting the drafting wrong could leave a lot of money on the table for the seller. Things like EMI schemes. So EMI schemes, for those who aren't familiar, is essentially it's an option scheme where you can grant employees options in a tax advantage way, and typically they'll be exercised 1 minute before the sale. So the employee acquires the share 1 minute before they sell it again. Not always, but that's typically how it works. In that situation, the company gets a nice fat tax deduction for the difference between what the shares are sold for effectively and what the employees paid for them. So again, just making sure that deduction, the benefit of that comes to the seller rather than the buyer. And I've seen examples where that deduction's been worth £1 or £2 million in terms of extra consideration. So it might seem obvious, but again, if it doesn't say it properly in the legal docs, or Ryan hasn't been aware of it and therefore hasn't been able to factor it into the working capital calculations, then you could be leaving money on the table. Things that HMRC don't like. We've touched on earn-out rights previously, and as I say, that there is a real risk if you get it wrong that could be treated as employment income. But sometimes what we'll see is you might have shareholders of the same class, but for some reason, and whether it's because they've got a different overdrawn loan account balances, the drafting might suggest that actually, even though it's exactly the same share, they're getting different prices for the same share. So, Rod may get £10 a share and Jane may only get £9 a share, but they both own, ordinary A shares. And the risk in that situation is HMRC say, well, actually, the share's only worth £9. What Rod's getting in terms of that extra pound is actually more of a distribution. We're going to tax that as dividend rather than capital gains tax. So really, again, making sure that the drafting's right to make sure that it all stacks up, not just commercially, but from a tax point of view, is really, really important as well. conscious of time and making sure that we've got time to get some questions in, but just a couple of other points here. So we touched about upfront elections, I think, where essentially if you receive loan notes or you receive shares, you can say to the tax office, well, I know I can defer the tax, but actually I want to actually pay the tax now, because that might get me a better tax rate, or it might help me to use up the remainder of my Entrepreneurs Relief £1 million limit. I think the key thing there is that if you've messed up and you think you're able to claim Entrepreneurs Relief BADR and you can't, well, you can't actually make this election either. So you are stuck with deferring the tax into a future period. So as a sort of the law of unintended consequences, I guess, if you haven't managed to get your Entrepreneurs Relief over the line, then you're actually reducing your flexibility around this as well. It's also a one in, all in. So you can't say, well, actually, I'd just like to sort of hedge my bets, please, and I'll kind of elect to pay half tax up front and defer half of it. You're kind of making a commitment and you're saying, well, it is one in, all in. And when, I mentioned about it being a one-way street, you can't get out of it. But if you elect to be taxed up front and the asset falls in value, so let's say you take shares on the assumption that they're going to be worth 10 quid a pop, but then actually they ultimately you sell them for only £8 because the buyer's actually made a bit of a mess of the business. If you've elected to pay tax on the £10 on day one, you can't get the tax back to the extent that it's fallen in value. You just get a capital loss, which most of the time is not worth the paper that it's written on. So there's some real key decisions you've got to make around this. And this, again, is where your tax advisors, can add some value. The beauty of it is that you do have quite a long time to make the decision as to whether you want to be taxed up front or not. But it's making use of that time and understanding what the consequences of doing it both upside and downside are really important. Employment-related securities, again, this is a whole minefield of an area, and I won't spend too long. But potentially, if as a part of the deal you get loan notes, or shares, then they could potentially fall within what's called the employment-related securities rules. And essentially, what that says is that an individual gets a security, which is usually a share, but can be a secured loan note, as part of their remuneration for their services, then that can be taxed to income tax rather than taxed as capital gains. Now, 99.9 times out of 100, this isn't a problem, but if there's, say, restrictions on the shares that you receive, so it says, well, you can't sell these for the next 3 years, that could reduce the value of those shares at the time that you get them. And what could happen then is that if those restrictions are later lifted, then you might end up paying income tax on the increase in value when those restrictions are lifted from the shares. So getting the paperwork in place to protect you from that sort of thing happening, if you're getting share or secured loan note consideration, can save a lot of pain into the future. Last couple of points, I think. So we mentioned right at the start of my session where, in certain situations, what might look like the sale of some shares, HMRC says, well, actually, you're just dressing it up as a sale of shares. But in fact, what's actually happening here is that you're kind of taking money out as a dividend and you're artificially making it look like a sale. So these are called the transactions in securities rules. If you're 75% of the business, then these rules are fine. You don't need to worry about it. But a PE transaction, you might only sell 70. Yeah. So you don't necessarily automatically fall into these. Now, if a PE investor's coming in, you might look at it and say, well, of course, it's a third-party transaction. But because there's just that tiny risk and because the consequences of the 70% that you are selling getting taxed as income, absolutely massive in terms of the tax that you pay, we'd always recommend going to HMRC just to kind of say, this is what we're doing it for good commercial reasons. Please just make sure that, please confirm that you're not going to apply the VAT legislation, the anti-avoidance legislation. And it's particularly actually an issue as well. And often we'll see it in MBO type situations where the seller might only be selling, 50, 60%. We had one where the seller only wanted to sell 49% to the management team, and the revenue came back and said, well, no, we're not having that because you're not actually passing control over. So we had to tweak the deal in order to get HMRC satisfied, because again, if we'd done the deal and they challenged it under this, the extra tax the seller would have had to pay would have been pretty significant. VAT is a thing I think that's overlooked on deals. There's a couple of aspects to it, and I've seen this go rather badly pear-shaped, where an individual's extracted a couple of commercial properties, they've bought it out of the business immediately prior to the sale, but what they'd overlooked was that about 25 years ago, they'd elected to charge VAT on the properties. So what then happened was, when they bought it out, they should have paid VAT. They didn't. They hadn't registered for VAT, and HMRC came along and said, well, I'm sorry, but you need to now pay VAT on the value that you bought out, and actually we're not that keen on letting you VAT register to be able to get it back either. So just understanding that if you're doing some pre-sale structuring, don't forget about the VAT. VAT on fees is another area where, you know, things can get quite complicated. If Ryan's selling your business, then, you know, typically I think corporate finance firms take the view that that's exempt from VAT, a view that I absolutely agree with, because what they're advising you to do is sell shares, and the sale of shares is not a taxable transaction from a VAT point of view, you know. But again, if the lines can start to get blurred, so if there's some strategic advice that's being provided as well as part of this, is that part of the sale of the shares? Possibly not. So really understanding the VAT, making sure, first of all, that you don't get charged VAT when you don't have to, but also what's the best way that we can get back any VAT that we are charged? Is there a mechanism? Thinking about that up front can save you, you know, potentially 20% of the fees that you're paying. It was a bit of a rattle through, but hopefully of interest. Sarah, have we got any questions that you'd like to throw at us at this stage?
Yeah, I've got a few that's come in. The first one is, what is a typical structure of a deal?
I mean, it can really vary, and I think the structure really comes down to what a buyer's view of the risk is going to be. For example, if you've got two customers or two main customers, and neither of them are contracted, a buyer is going to be really hesitant to give you an awful lot of money up front, because they're going to want to make sure those customers continue. I think, you know, if it's really doing whatever you can to try and mitigate that risk to get as good a structure as possible. If a business is really heavily reliant on the shareholder who's looking to exit, again, that's going to really impact the amount you're going to get on day one, because a buyer's going to go, well, hang on a minute, if this guy has loads of important relationships and he wants to leave on day one, you know, I don't really want to be giving him a lot of cash on day one. So all those being well, if you've got a good spread of customers, you know, you've got a good management team, or the owner manager is willing to stay for a good period of time. I mean, typically what we're seeing at the minute is you get between 70 and 75% up front, which is really good. What we're seeing a lot more of at the minute, again, and it comes back to this risk and reward part, is deferred consideration is not really. We're seeing a lot less of it now, and a lot more buyers are really keen on earnouts. Now, it's not necessarily you need to grow the business, but it's more you need to maintain at the level it is. So yeah, I think if you can get sort of 70 to 75% up front, and, you know, either deferred consideration or a fairly attractive earnout target, that's a good structure which you should be happy with.
Thank you. And another question that's come in is, what are your top tips for selling a business?
Get advisors in early is always a good one, and I think, you know, so Paul demonstrated that really well in terms of just what advisors can add, and the sooner you can get in terms of just making sure things are structured properly, and, you know, that particularly if there is EMI schemes, etc., coming in, or, you know, if you want to pass shares to a family member, you know, a husband or a wife, that's really beneficial because of the 2-year rule. But getting that in early and making sure people maximise, you know, the tax reliefs available to them is really important. In terms of just maximising the value as well, we touched on it going through it in terms of the cash-free, debt-free, and really minimising that debt in the business is really important. So if you can pay off an ID line, you know, if there's ways to buy assets where you're not getting debt in, that's really good. If you're an owner manager and this is a retirement sale and you want to go, making yourself redundant is quite helpful. So making sure there's a good management team in there below you, and the buyer can look at it and go, actually, this guy's not important, and they can go. Customer concentration is really a big point, and again, just making sure you've got a good spread of customers. Buyers don't like looking at a business and 90% of the revenues coming from 5 businesses. It just red flags straight away there. So if you can get a really nice spread of customers, that's really helpful. And again, something which we encourage as strongly as possible is making sure you get a really good set of corporate lawyers. We've worked with good corporate lawyers, and we've worked with sort of businesses where the guy's using his friend from down the road, and the difference is astronomical. And again, it really comes to value. So making sure that you've got some really good lawyers in your corners is really important as well.
Yeah.
And also, someone wants to know, how early should you start planning for a sale?
Again, as early as possible. We're as a team, we're happy to meet people at any kind of stage of a process. So, if someone's only thought about it now and it's actually 10 years away, they're looking to, we're always more than happy to meet someone and just sort of give tips like that in terms of paying off the debt. If you do want to go, making sure you're making sure you've got a team in there to run it, tips around the customers, giving that advice. So as soon as you think it might be a plan or it's something you want to do, I think speaking to people, speaking to advisors is really helpful. I think Paul's probably a good one to come into this in terms of the tax planning side of it.
Yeah, well, I think, and we touched on the two-year rule for Entrepreneurs Relief, BADR, and I mean that that's the minimum. So yeah, we'll quite often be looking to potentially say, well, maybe we look to shift some shares to a spouse in advance of the sale, because they would then potentially be able to access another £1 million worth of the 10% tax rate. But if you do that 1 year and 364 days before the deal, then that ain't going to qualify. So, from a tax point of view, there's a lot of kind of 1 or 2 year kind of thresholds that you have to be over. And obviously you don't want to be making decisions in a rush. So I always say, from a tax perspective, kind of 3 years out is probably the minimum in some ways that you would start to think about, because that then gives the opportunity to tie in people in EMI schemes as well and things like that. So there isn't an easy answer. I would just say as soon as possible. Don't wake up on Monday morning and think, that was a terrible week last week, I'm going to sell it. But
which we have saved.
Yeah, and it just limits the room for manoeuvre so much, doesn't it? Right. But I think, I would say from a tax perspective, no less than 2 years, but probably ideally no less than 3.
Thanks, gents. And finally, what sort of areas do buyers tend to focus on in tax due diligence?
This is a really interesting one. I say this sometimes part jokingly, but often quite seriously, that most tax issues that come out that we see these days aren't brought up by HMRC. They're actually brought up by buyers as part of a DD exercise. Things that can go wrong if you've done a previous restructure. Has that been documented correctly? I did hear about a deal which fortunately I wasn't involved in, where for whatever reason a restructure had been done, but the company that everybody thought owned the shares didn't actually own the shares. So the company that the buyer was looking to buy was just a holding company and didn't actually, because they hadn't completed the transaction correctly. So they effectively had to go back and revisit the entire transaction. So previous restructures, have you had an HMRC clearance on it? Have you done what you said you were going to do in the HMRC clearance is a big area people will focus on. I think EMI schemes, if they're done right, they're great. If they're done badly, they can really be problematic. So if you're getting an EMI scheme, an example was, a client thought, issued some options, got the lawyers involved, got the tax advisors involved, and everything went smoothly. They then thought 12 months later, we need to issue some more options. So they just basically recycled the paperwork from the previous issue. The only problem being that the rules had actually changed in the intervening period. And so the second set of options didn't strictly qualify as EMI options. And the buyer picked that up because effectively, if those options had been exercised, there would have been a massive pay-as-you-earn and national insurance liability. So, you know, cutting corners might save a little bit of cost in the short term, but it throws up some big issues. And the other favourite one, I think, particularly relatively recently, is around contractors and the whole IR35 thing, which, you know, people will look at. If you've got people who aren't employees but seem to be working there quite a bit, you know, have we got a risk around this, and are we going to get pinged by HMRC? And therefore, if we are, well, first of all, you know, we're going to keep you on the hook, but secondly, we might want to change the entire relationship between the business and these individuals. So they're probably, you know, there's a lot of areas, but they're three that we've certainly seen recently. So
Thanks very much, gents. If you could just move to the next slide, Paul.
ta-da.
Don't forget to follow us on Eventbrite, and we have a couple more webinars coming up in September. So if you jump on there, you can secure your place for our next event. Thank you very much, gents.
Oh, thanks, Sarah. Thanks, everybody.
Thanks,
Bye now.
everybody.
Bye.
Bye.